Hi, I'm John Mark Young of Whitaker-Myers Wealth Managers, and welcome back to the Question of the Week video. This week's question is about a topic that is making the headlines right now, this very week. Today, February 1st, 2025, we learned that President Trump followed through on one of his agenda items, and that is that the U.S. will impose 25% tariffs on nearly every import from Canada and Mexico. Not only that, but he's also including that a 10% tariff on energy products from Canada and an additional 10% tariff on China. Let's get that one right. China, effective Tuesday. And this is, of course, sparking a continental trade war that we will see how it plays out. Now, this was all announced today, and the White House said that tariffs are going to be imposed under an emergency economic authority. You can't just impose tariffs without some sort of rationale as the president. And so the White House is saying, hey, we have all this fentanyl and we have all of these drugs coming through Mexico and Canada, and it's originating in China. And so that is creating an economic problem for us and a health crisis. And so because of that, they're using an emergency power to add these tariffs on to Canada, Mexico, and China. Of course, this is a white hot political issue, which we don't want to get into. But here's the question of the week that we want to answer is, are tariffs and why can tariffs be good for the stock market? Everything you hear, I'm sure, is going to be about how tariffs are going to be negative for the U.S. economy, negative for the U.S. consumer, and negative for the stock market. Well, is that really true? All of 2023, we were told from these same experts, economists, that no doubt we're going into recession, which never transpired. We did not go into a recession. For many, many years in President Trump's first term in office, we were told tariffs are bad. But were they actually bad? That's the question we're going to dive into. Now, what are tariffs? Tariffs are taxes that are imposed on imported goods we're bringing into the United States. And of course, that makes those foreign products more expensive compared to ones that are just created here domestically by U.S. manufacturers or producers. The goal, of course, is to encourage consumers and businesses to buy locally, be focal, shop local. It's a slogan in our town, boosting domestic industries. Again, the fear and what you're going to hear is that tariffs could lead to trade wars. Now, we will get tariffs on our goods that we send overseas. Of course, we are in a trade deficit, so that means that actually that doesn't hurt us as bad as tariffs help us. And these higher costs that now U.S. consumers are going to pay are going to dwindle the economy. But can they also create investment opportunities? Well, yes, we would make the argument that tariffs can and do benefit the stock market. Now, again, I would be chastised, maybe will be chastised for making this argument, but let's break it down. Let's actually look at some real examples. How about point number one that I'll make is tariffs boost domestic companies. No doubt, no brainer. Baseline example there. That's not anything that somebody doesn't know, but it seems to be things that we don't hear about when we're talking about tariffs, other than Peter Navarro, who is President Trump's kind of trade czar. But higher import costs give domestic businesses a competitive edge, as we talked about, and it's going to increase demand for their products. This can lead to stronger earnings, and stronger earnings typically lead to stronger stock performance for these U.S. companies. Let me give you a quick example. Caterpillar, that's ticker symbol CAT. They're a leading manufacturer of construction and mining equipment. They have benefited from tariffs on foreign machinery, and that has increased their domestic sales and gone right through to their stock performance. So I think Caterpillar would say, and maybe why they were very excited about President Trump's reelection, that tariffs were good for us. How about the second thing is tariffs can increase corporate investments. One of the arguments I've heard from a lot of the talking heads on CNBC and Fox Business and those sort of places is that we don't have the production capabilities to deal with the increased demand. Well, how do you create the production capabilities? You make corporate investments. And that is point number two that we think why tariffs lead to improvement in the stock market. With tariffs in place, companies may and probably will invest in domestic infrastructure within their factories, within their places of manufacturing, and even in labor, in people. And those investments tend to lead to higher productivity. Productivity is one of the major benefits to stock performance because when you're more productive with the same amount of goods, or you make an investment that makes you more productive with the same amount of money spent there, and you can become more profitable. And more profitability, as we talked about in point number one, is good, very good for shareholders. Let me give you another example. U.S. Steel. Of course, steel was the big tariff deal last time with China, and that expanded production for U.S. Steel because they made major corporate investments. What do? They reopened plants following tariffs on imported steel, and that has driven up their stock value over the last few years. How about point number three? Sector-specific gains. Certain industries, certain sectors like steel, like manufacturing, like agriculture can benefit directly from these tariffs as they experience less competition from their foreign suppliers or foreign competition of foreign suppliers of goods to the U.S. Stocks in these sectors may see an uptick in performance, and you need to look no further than somebody like Deere & Company, ticker symbol DE, and they're a major agriculture equipment manufacturer, and they've seen higher demand for their domestically produced machinery as tariff on their foreign competition, the alternatives, made those foreign options just less competitive. And of course, point number four is there's increased government revenue when you impose tariffs. Tariffs create government revenue. As we've talked about many times, not necessarily me, but President Trump, this is the way that the U.S. generated revenue, government revenue, before income taxes. So with this revenue, along with an income tax that we still charge, this can be reinvested into things like infrastructure, defense, public projects, and those sort of things stimulate economic growth. Or how about this? That government revenue, as President Trump has said many times, can be reinvested into the Jobs and Tax Act extension, and maybe even creating new tax benefits, such as no taxes on tips. How do you pay for that? You got to pay for it. Maybe one way you're paying for it is tariffs on foreign produced goods. History shows us that strategic tariffs, and that's the key, strategic tariffs have led to stock market booms. As I've talked about, tariffs on steel and aluminum in recent years have helped drive and boost domestic production. And then those stocks in those industries, of course, responded positively because of all that boosted domestic production. Additionally, during periods of economic nationalism, markets often rally because there's going to be increased profits, and as a result of the investments we talked about, increased employment. Now, as we know, I'm not dumb enough to say, hey, tariffs don't have their risks. If they're not managed properly, they can lead to retaliatory tariffs from other countries, potential inflation issues. That's one big argument, and maybe even supply chain disruptions, which of course was the major issue from COVID that created all the inflation that we had last year, was supply chain disruptions. However, when implemented strategically, and I believe that the team in place is implementing them strategically, just like they did the last time they were in office. And oh, by the way, the administration following them, if they're so bad, why didn't they rip them off right away? They did not rip them off. They kept them there. Why? Because they know deep down they can serve, and were serving as a catalyst for economic and stock market growth. So these are things that we at Whitaker-Myers monitor closely, all of these economic policies, including tariffs, to help make our clients be more informed about their investment portfolios. It's not necessarily that you go out and trade all these actions and things that are happening. It's not your investment portfolio needs to change because of that. Now, maybe within the funds that you invest in, there are changes that are happening and updates that are being made. But understanding how these policies impact the market can be a game changer for the hardest thing that you have to do, which is behavioral finance. If I can stay out of my own way with my investments, I'm probably going to win. Fidelity did a study years ago that said, hey, our best performing accounts were from dead people. What? How do dead people have accounts? Well, of course, if Susie dies and the beneficiaries never come get their money, it just stays there till the beneficiaries come get the money. Those accounts were the best performing accounts. Was it because people that right before they die have an investment genius and pick the right stocks? Of course not. That's silly. It's a bad argument if you make that. Don't make that argument. What they did is they didn't have the ability to hit the sell button. They couldn't get on Kramer and go sell, 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 sell. Because they didn't sell, they didn't react emotionally. They just stayed invested. It's the key to success in the stock market. Knowledge and consistency. Knowledge and consistency. If I can be consistent with my savings, if I can be consistent with my investment strategy, I can understand, which helps me be consistent, then I'm going to do well, more than likely. So, hopefully that was helpful to you. Thanks for watching this week's video. And as always, you can do us a favor by hitting the like and the subscribe button. When you hit the like button, it helps our content be pushed out to more people on the YouTube and Rumble algorithm, as well as when you hit the subscribe button, our content gets pushed to you as we release it. And you can go to the comment section of this video as well if you'd like to talk to any of our financial advisors, planners, or coaches who can help you in baby steps 1, 2, and 3. It's mainly our coaches, get you out of debt, keep you on a budget, make sure you're doing the right thing. And of course, baby steps 4, 5, and 6, where they will help you build a plan so you can eventually get to baby step 7, where you can live and give like no one else. Thanks so much for watching this week's video. We'll look forward to seeing you next week.